$2.1 trillion. That is not a budget line item. It is a death sentence for the American middle class. As of this week, the Congressional Budget Office has confirmed what every honest economist has feared for years. The interest payments on the United States national debt will more than double to $2.1 trillion per year by 2036. That number is larger than the entire defense budget. It is larger than Medicare. It is larger than every federal investment in roads, bridges, schools, and scientific research combined. And the most terrifying part is that the math has already crossed the point of no return. The average interest rate on federal debt is now 3.3% and climbing. By the end of this decade, it will exceed the rate of economic growth itself. When that line crosses, a debt spiral begins. Not a theoretical risk, not a future concern, a mathematical certainty baked into signed contracts and existing obligations. The United States government is now paying more to service its past mistakes than it spends on its future. And you, the American taxpayer, are the collateral. For decades, the system worked because of a simple trick. The economy grew faster than the cost of borrowing. If the government owed $100 billion but the economy expanded by 5%, the debt shrank relative to everything else. Politicians could borrow freely, spend lavishly, and never face the consequences. It was the greatest financial illusion in human history. But that illusion has officially shattered. The Congressional Budget Office projects that publicly held debt will hit 106% of gross domestic product by 2030. That breaks the post-World War II record. By 2036, it reaches 120%. In the worst-case scenario, 131%. These are not numbers from a fringe blog. These are the government's own projections, published on Valentine's Day 2026. A love letter from Washington to Wall Street, written in red ink. Before we break down exactly how this debt spiral destroys your purchasing power, your retirement, and your standard of living, please make sure you are subscribed to the channel so you do not miss the daily updates on this unfolding crisis. And comment down below, dollar or gold? Which asset do you trust more to protect your family over the next 10 years? To understand why this is not just another scary headline, you need to understand the mechanics of a debt spiral. It is the most dangerous feedback loop in economics, and once it starts, no government in history has ever stopped it without either defaulting or destroying its currency. Here is how it works in plain language. The government borrows money by issuing treasury bonds. Investors buy those bonds and earn interest. The government pays that interest from tax revenue. But when the interest payments grow larger than the tax revenue can cover, the government has to borrow more money just to pay the interest on the old money. You are borrowing to pay interest on borrowing. This is the definition of a Ponzi scheme operating at the sovereign level. The Congressional Budget Office has laid out the numbers with brutal clarity. The current average interest rate on all federal debt is 3.316%. It will rise to 3.4% this year and 3.9% by 2036. Meanwhile, nominal economic growth, the combination of real growth and inflation, is projected at 4.1% this year, cooling to 3.9% in 2027 and 3.8% after that. Do you see the crossover? The interest rate on the debt is rising. The growth rate of the economy is falling. They are on a collision course. And when they meet, the spiral ignites. What they are not telling you is that these projections assume the best-case scenario. They assume no recession, no new wars, no pandemic, no financial crisis. They assume Congress will let tax cuts expire and will not pass any new spending programs. In other words, they assume a discipline that Washington has never demonstrated in modern history. The reality will be far worse than the baseline. The deficit is projected to hit $3.1 trillion by 2036 under the optimistic scenario. Under realistic assumptions, it reaches $3.8 trillion. That is $3.8 trillion of new debt every single year, piled on top of the $31 trillion that already exists. But the story does not stop at the federal level. This is where the cascade begins. And it is the part that no mainstream analyst is willing to say out loud. The rising cost of government borrowing does not stay contained in Washington. It radiates outward through every layer of the economy like radiation from a cracked reactor core. When the Treasury has to offer higher yields to attract buyers for its bonds, every other interest rate in the economy rises in lockstep. The 10-year Treasury yield is the benchmark for mortgage rates, auto loans, corporate debt, student loans, and credit card APRs. When Treasury yields spike because of excessive government borrowing, every American household pays the price directly. This is the crowding out effect, and it is the silent killer of middle-class prosperity. The government is sucking up all the available capital in the economy to fund its deficits. There is less money left for businesses to borrow, less money for home buyers, less money for entrepreneurs. The cost of capital doubles and the private economy suffocates. We saw a preview of this in 2023 and 2024 when mortgage rates hit 8%. Home sales collapsed to their lowest level in decades. But that was just the appetizer. If the debt spiral accelerates as the Congressional Budget Office projects, we could see sustained mortgage rates above 9% for years. Not because of inflation, not because of the Federal Reserve, but because the government is drowning in its own debt and dragging you down with it. But here is where it gets worse. The Federal Reserve is trapped in a cage of its own making. In a normal downturn, the Fed cuts interest rates to stimulate the economy. But cutting rates in a debt spiral is like pouring gasoline on a fire. Lower rates mean the government can borrow even more cheaply, which encourages even more spending, which adds even more debt, which requires even more borrowing. The spiral accelerates. Alternatively, the Fed could restart quantitative easing, buying government bonds with freshly printed dollars. But this is pure monetization of the debt. It is the central bank financing the government directly by creating money from nothing. Every dollar printed dilutes the value of every dollar you have saved. This is not stimulus, it is confiscation through inflation. The Federal Reserve paused its rate cuts in January 2026 and is expected to hold again in March. The market was expecting 3 more cuts this year. But a stronger than expected jobs report on February 11th sent Treasury yields surging as traders realized the Fed has no room to move. The economy is too hot to cut, but the debt is too large to sustain at current rates. The Fed is caught between a rock and a hard place, and the rock is getting heavier every quarter. This brings us to the most terrifying parallel in modern economic history: Japan. In 1989, Japan's asset bubble burst spectacularly. The government responded by borrowing massively to stimulate the economy. Sound familiar? They kept interest rates at zero for decades, piling up debt until it reached 260% of GDP. The result was not a recovery, it was a lost generation, 3 decades of stagnation, deflation, and economic decay. The Japanese stock market took 34 years to recover its 1989 high. An entire generation of Japanese savers and investors lost everything waiting for a recovery that never came. The United States is now walking the exact same path. But there is a critical difference that makes the American situation potentially more dangerous. Japan borrowed from its own citizens. Over 90% of Japanese government debt is held domestically. The Japanese people funded their own government spending binge. America does not have that luxury. The United States relies on foreign creditors to finance roughly a quarter of its national debt. China, Japan, the United Kingdom, and dozens of other nations hold trillions in treasury bonds. And they are losing patience. The latest Treasury International Capital data shows a disturbing trend. Foreign central banks are reducing their holdings of US Treasuries at the fastest pace in years. China has been selling aggressively, with Chinese and Hong Kong combined holdings sitting at $938 billion and falling. Beijing recently instructed its banks to limit their treasury exposure, citing volatility and security concerns. Brazil dumped $61 billion in a single year. India shed $47.5 billion. The buyers are disappearing at the exact moment the government needs them most. This is not a coincidence. It is a coordinated strategic withdrawal from the dollar system. The smart money at the sovereign level sees the debt spiral forming and is getting out before the bonds lose more value. They are converting their treasury holdings into gold, commodities, and bilateral currency agreements that bypass the dollar entirely. The World Gold Council reports that central bank gold purchases have reached their highest level in over 50 years. They are not buying gold because they enjoy collecting shiny metal. They are buying it because it is the only reserve asset that cannot be debased by a politician or frozen by a sanction. But the damage does not stop at the sovereign level. There is a third front opening in this war against your wealth, and it is happening inside the American banking system right now. Banks hold trillions of dollars in treasury bonds and agency debt on their balance sheets. When interest rates rise, the market value of those bonds collapses. According to the FDIC, US banks are sitting on over $600 billion in unrealized losses on securities. These are bonds they purchased when rates were near zero, which are now worth 30 to 40% less. As long as the banks do not sell them, they can use a strategy called hold-to-maturity accounting, pretending the losses do not exist. But this is mark-to-fantasy, not mark-to-market. The losses are real. The money is gone. And if depositors get nervous and start withdrawing funds, the banks are forced to sell those underwater bonds at catastrophic losses. We watched this exact scenario destroy Silicon Valley Bank in 2023. The difference now is that the problem is systemic. It is not one bank. It is hundreds of banks, collectively hiding $600 billion in losses behind an accounting trick. The debt spiral makes this worse every single day. As government borrowing pushes yields higher, the unrealized losses on bank balance sheets grow larger. The banks become weaker. Their ability to lend shrinks. The credit crunch deepens. Small businesses cannot get loans. Consumers cannot refinance. The real economy suffocates while Washington borrows another $1 trillion. And this brings us to the part that should keep you awake tonight. The Federal Deposit Insurance Corporation, the agency that guarantees your bank deposits, holds approximately $125 billion in its deposit insurance fund. That sounds like a lot until you realize it covers only 1.17% of the $12.6 trillion in insured deposits across the American banking system. If even a small fraction of banks fail simultaneously, the FDIC runs out of money almost immediately. The system is designed to handle 1 or 2 bank failures at a time. It is not designed for a systemic crisis triggered by a sovereign debt spiral. In that scenario, the government has 2 options: print trillions to bail out the banks, destroying the currency, or invoke the bail-in provisions of the Dodd-Frank Act. A bail-in is the legal process by which your deposits, your money sitting in your checking account, are converted into bank equity to save the institution. Your cash becomes shares in a failing bank. This is not a conspiracy theory. It is written into law. It happened in Cyprus in 2013 when depositors lost up to 60% of their savings overnight. The legal framework exists in the United States right now, ready to be activated. Most Americans have no idea this provision exists because nobody in Washington wants to discuss it publicly. Let me bring this back to you personally because this is not an abstract macroeconomic discussion. This is about your life. Your retirement account is invested in bonds that are losing value every single day the debt spiral continues. Your 401k is almost certainly holding treasury bonds or bond funds that are being quietly destroyed by rising yields. You log into your brokerage account and see a number, but that number is a lie. It does not account for the inflation that is eating your purchasing power from the inside. You are getting poorer every single month while the government tells you the economy is strong. Your mortgage rate, if you need to refinance or buy a new home, is directly tied to the 10-year Treasury yield that the debt spiral is pushing higher. Your credit card APR has already crossed 22% on average, the highest in recorded history. Your car loan, your student loan, your business line of credit. Every single form of debt you carry is getting more expensive because the government cannot control its spending. You are subsidizing Washington's addiction with your paycheck, your savings, and your future. And here's the dirty secret that no one in the mainstream media is discussing. The government does not need to raise your tax rate to take more of your money. They just print more dollars, which dilutes the value of the dollars you already have. You work for dollars. You save in dollars. But the government creates dollars for free, diluting your labor with every trillion they borrow. Inflation is a stealth tax, and it is the most regressive tax in existence because it hits the people who save the hardest. The wealthy own assets that rise with inflation: stocks, real estate, gold. The middle class holds cash and bonds. Cash loses value. Bonds lose value. The wealth transfer is mechanical, mathematical, and merciless. They privatize the profits of the boom and socialize the risks of the bust. Every single time. And this time, the bust will be larger than anything we have seen since the Great Depression. Because the debt is larger, the leverage is larger, the foreign exposure is larger. And the tools to fix it have already been exhausted. The data that the regulators are praying you do not see paints a picture of a system under extreme stress. The first bank failure of 2026 has already occurred. Metropolitan Capital Bank and Trust in Chicago, with $261 million in assets, was seized by regulators on February 2nd. The cause was tied directly to commercial real estate exposure, and there are hundreds of banks with far worse concentration ratios sitting on the edge of the same cliff. The maturity wall of $2 trillion in commercial real estate debt peaks this year. Regional banks hold 70% of those loans. The debt spiral is tightening the noose from above while the real estate crisis erodes the ground from below. The banks are being crushed between two forces, and your deposits are caught in the middle. The window of opportunity to protect yourself is open right now, but it is closing with every passing quarter. Every $1 trillion of new debt narrows the path to safety. Every basis point increase in yields tightens the noose around the banking system. Do not be the last person standing outside the bank on a Monday morning wondering why the doors are locked. By the time they admit there is a crisis, the capital controls will already be in place. Here is what you can do right now, not next month, not next year, right now. Step 1. Audit your banking exposure immediately. Do not keep more than $250,000 in any single bank account. That is the FDIC insurance limit. Spread your deposits across multiple systemically important institutions. The too big to fail banks are not safer because they are better managed. They are safer because the government has implicitly promised to bail them out. Use that guarantee to your advantage. Step 2. Reduce your exposure to long-term bonds. If you are holding treasury bonds, corporate bonds, or bond funds with maturities longer than 2 years, you are sitting on a ticking time bomb. Every basis point increase in yields reduces the value of your bonds. Rotate into short-term treasury bills, which mature in 3 to 6 months and can be purchased directly through Treasury Direct. You earn competitive yields without the duration risk that is destroying long-term bondholders. Step 3. Acquire hard assets that exist outside the financial system. Physical gold and silver, not ETFs or paper claims, but metal you can hold in your hand. Central banks around the world are buying gold at record rates because they understand what is coming. The billionaire exit strategy involves selling financial assets and acquiring land, commodities, and precious metals. If the smartest money on the planet is moving into hard assets, you should be paying attention to that signal. Step 4. Eliminate variable rate debt as quickly as possible. Credit cards, adjustable rate mortgages, and floating rate loans are the financial equivalent of standing in an open field during a lightning storm. As the debt spiral pushes rates higher, your monthly payments will increase automatically. Lock in fixed rates where you can and pay down variable debt aggressively. Your future self will thank you when rates hit levels that would make today's borrowing costs look like a bargain. Step 5. Build a liquid emergency reserve that covers 12 months of expenses, not 3, not 6, 12. In a credit crunch, access to capital is everything. Companies that have cash survive. Individuals who have cash have options. Everyone else is at the mercy of a banking system that may not be functioning normally. The debt spiral is not a prediction. It is a process that has already begun. The Congressional Budget Office has given you the roadmap. The interest rate on the debt is rising. The growth rate of the economy is falling. The crossover point is approaching within this decade. When it arrives, the mathematics become irreversible. No amount of political will or monetary magic can stop a debt spiral once the interest payments exceed the economy's ability to grow. The Federal Reserve knows this. The Treasury Department knows this. The foreign central banks who are dumping their holdings know this. The only people who do not know this are the ordinary Americans whose savings, retirements, and livelihoods are on the line. That changes today. You have the information, you have the data, you have the numbers that the government published and hoped you would not read. Now you have the choice. You can pretend the math does not apply to you, that the greatest nation on earth could never face a sovereign debt crisis. Or you can look at the numbers, accept the reality, and take action to protect everything you have built. The smart money is already moving. The central banks are already buying gold. The foreign creditors are already selling. The only question left is whether you will act before the window closes or after. History does not reward the complacent. It rewards the prepared. And right now, preparation is the most valuable investment you can make. Subscribe to the channel and turn on the notification bell so you are alerted the moment the next crisis signal drops. Share this video with anyone you know who has a retirement account, a mortgage, or savings in a bank. They deserve to know what the government's own numbers are telling us. The algorithm does not like this kind of hard economic truth, so we need your help to spread it. Together, we can navigate this collapse and emerge with our wealth and our freedom intact. Stay liquid, stay skeptical, stay ahead. I will see you in the next video with more data, more analysis, and more truth.